The objective of this webinar is to make you aware of the important difference between trading and investing. In recent years, a number of organizations have come into existence claiming to be able to teach ordinary people how to make money from derivatives, like currencies, single stock futures, options, and contracts for difference, or CFDs as they are known. Derivatives are instruments whose value is derived from an underlying security, like a share, a currency, or a commodity. These instruments are extremely highly geared, anything between 10-fold and 100-fold, which makes them very, very risky. So, for example, a currency future only requires the trader to put down 1/100th of the value of the underlying currency which he is trading. So a 1% move in that currency results in the value of the futures contract either doubling or being completely wiped out. Other futures and options contracts are usually geared 10-fold, so that a 10% move in the underlying instrument will either double or wipe out the value of the derivative contract. The purpose of this webinar is to demonstrate that trading in derivatives is virtually the same as playing the roulette table at the casino. It is definitely not an investment. It is an out-and-out gamble. So you need to ask yourself whether you would be willing to take your hard-earned after-tax savings and risk it on the spin of the roulette wheel. Because buying derivatives is very much the same thing as the roulette table, and it has about the same chance of a successful outcome. Only a fool gambles his serious money on a completely random event. Investment in high-quality shares on the JSE, however, is entirely different. Investing is not any kind of get-rich-quick scheme. Rather, it is a get-rich-slow scheme. To be successful with shares, you need to be patient and give your investments time to grow. Get-rich-quick schemes, like trading in derivatives, simply do not work. They rely on the same appeal as the roulette table at Monte Cassino, the temptation to make a quick win. They appeal to impatient people. But we all know that you cannot make money on the roulette table or by gambling at the casino. That is precisely why casinos are highly profitable, because people who gamble continuously at the casino will end up losing everything they have. Derivatives are much the same. They are what is called a zero-sum game. In the derivatives markets, if you add up all the winners and subtract all the losers, you will come back to zero. And then, of course, the market itself takes its commission, just like the casino. That is very different from investing in a company like, for example, Dis-Chem, where you have a team of directors who go to work every day and do everything they can to build and grow that business. Dis-Chem opens between 15 and 20 new stores every year. That is real growth in a real business, and one which you can understand because you and your spouse shop there quite regularly. If you own Dis-Chem shares, then you will participate in that growth. But like all truly good things, it is not going to happen overnight. You have to have patience. Ultimately, wherever there is a Click store, there can be a Dis-Chem on the other side of the corridor, which means that Dis-Chem can expand its store base from about 150 stores to around the 700 stores which Clicks currently has. And that is what investors call blue sky potential, a great long-term opportunity in an extremely well-run company. To trade on the derivatives markets, you will need to watch them constantly. If, like most people, you have a job and go to work every day, you will not be able to watch your open positions in the derivative market all the time because you will be at work. While you're at work, you run the risk of losing a lot of your hard-earned capital very quickly. In the derivatives market, such as in the casino, you can lose tens of thousands of rands in just a few minutes or even a few seconds. In the share market, things move much more slowly, and you have plenty of time to consider your position and adjust your investments when you need to, without incurring huge losses. The derivatives markets are also dominated by full-time professional traders, working mostly for the big banks and financial institutions. These professionals have a huge advantage over private investors, because this is their job, this is what they do all day. They have the latest computer equipment and can calculate the fair value of any derivative contract in a fraction of a second. They usually have billions of US dollars at their disposal, and they can push the price of the contract up or down if they want to. You have no such advantages. And anyway, most of your time you will be at work, not sitting hunched over the computer screen. In a word, they will eat you for breakfast. A study done in America has shown that private individuals are very unsuccessful in the derivatives markets. Only about 1 in 20 actually makes money over the medium term. So you have to ask yourself whether you are that one person out of 20 who's going to be successful. Are you going to risk your hard-earned after-tax savings on the roll of a dice? We suggest that you learn to be a long-term investor and leave the trading of derivatives to the gamblers.